pleasant day to you, potential homeowners. So you want to buy a home? Well, there are things to consider before talking to your bank or your mortgage lender. Let's make sure that your finances, your credit, and your assets are all in order. Keep in mind that this is not the loan process, but rather preparing yourself before going to the lender so they don't turn you away. When you meet with your lender, your goal is to get that pre-approval letter so you can start looking for a house. So let's get prepared. The first thing on the list is your debt to income ratio. The bank or lender will need to know what is called your debt to income ratio. This is what they will use to determine whether or not you can afford to repay the loan. To calculate this, add up all of your monthly payments. This will include your monthly housing expenses like your credit cards, your loans, car payments, rent, child support, and anything else that will show up on your credit. Divide that total by your gross income for the month. Your gross income is the amount that you receive before any deductions are taken out. Then multiply your answer by 100. You want this number to be as low as possible. Yes, very low. The ideal number should be around 37 to 35% or below. Next on the list is your credit. They are looking for at least 4 trade lines that have been established for about 2 years or more. The higher the credit score, the better. You want to be in the 720 to 850 range, so make sure that you are paying your bills on time. Late payments, maxed out trade lines, or no activity will reduce your credit score. A 620 to 719 will still get you qualified, but the loan program and the terms might be a bit less favorable. For example, you might have less loan programs available to you, and you will also possibly get a higher interest rate. So start working on getting those scores up. The third item on the list is buying a car. Please, please, please do not buy a car or any other big ticket item. Even if you feel like you can afford the car payment, mortgage companies approve your loan based on their guidelines, not yours. If you have not already bought a car and you are looking to buy a house, try to close on the house first before getting the car. Your lender usually pulls the credit again just before closing, and a car payment that wasn't already there could end the whole buying process. That's right, no keys and no big beautiful house for you. This could be really bad in certain situations. Let's say that the seller was waiting on the closing so they could close on their house that they're buying based on the fact that they're selling this house. Or maybe the sellers were occupying the home and they have already packed up and moved out anticipating the closing. Another problem could be that you have given up the lease on your apartment or wherever you were living, and now you don't have a home and you don't have an apartment, so you have nowhere to live. The fourth item on the list is moving money around. When a lender reviews your loan package for approval, one of the things they are concerned about is the source of income for your down payment and your closing cost. Most likely, you will be asked to provide statements for the last 2 months on any of your liquid assets. This includes checking accounts, savings accounts, money market funds, certificate of deposit, stock statements, mutual funds, or even your company 401k and retirement accounts, depending on which one your funds will be coming from for closing. The bank will also require any paper trail for all large deposits made into your account. You may be required to provide proof of where the money originated from. Perhaps you become annoyed with your lender, but they're only doing their job correctly. To ensure quality control and eliminate potential fraud, it is a requirement on most loans to completely document the source of all funds. Moving your money around, even if you are consolidating your funds to make it easier, could make it more difficult for the lender to properly document. So leave your money where it is until you have taken the time to sit with your bank or loan officer. The fifth item on the list is changing jobs. For most people, changing employers will not really affect their ability to qualify for a loan as long as it is in the same line of work. An example would be a teacher changing schools or a nurse or doctor working in a different hospital or medical facility. However, you could have a problem if you change professions within a certain time frame. Just make sure to remain in the same line of work. If you switch employer, hopefully you will be earning a higher salary, which will help you better qualify for a mortgage. If a substantial portion of your income is derived from commissions, you should not change your jobs before buying a home. This has to do with how your income is calculated. They average your commissions over the last 2 years. Changing employers creates an uncertainty about your future earnings from your commissions. There is no track record from which to produce an average. Even if you are selling the same type of products with essentially the same commission structure, the bank cannot be certain that past earnings will accurately reflect future earnings. If a substantial portion of your income on your job will come from bonuses, you may also want to consider delaying an employment change. The lenders will rarely consider future bonuses as income unless you have been on the same job for 2 years and have a track record of receiving those bonuses. Then they will average your bonuses over the last 2 years in calculating your income. Changing employers mean that you do not have the 2-year track record necessary to count bonuses as income. Number 6, keep all your documents in one place. As soon as you talk to your lender, they are going to be asking you to start sending documents like 2 years tax return, your last 2 years W-2, your last 2 or 3 months bank statements, and so forth. In some cases, they might even ask for up to 1 year bank statement depending on your line of work. They will ask for proof of other income like child support, disability income, income from a second job, and so on. So make sure that you can find everything that they're asking for, and the way to do that is to keep everything in one place. Number 7, don't make any major purchases that will show up on your credit. Don't go on a spending spree using your credit if you are thinking about buying a home or in the process of buying a home. Your mortgage pre-approval is subject to a final evaluation of your financial situation. Every $100 you pay per month on a credit card could cost you about $10,000 in home eligibility. For example, a payment of $300 per month could mean that you qualify for $30,000 less in mortgage loan. If you need furniture, wait until after you have purchased your home. Even if you have accumulated enough savings, you should probably wait. The last thing you want is to know that you could have purchased your home had you curbed the urge to spend. Number 8 is our final item on the list. Save, save, save your money. You are going to need money for your down payment. You are going to need money to pay for your inspection. You'll need to pay for your appraisal. You are going to need money to buy homeowners insurance. And in some cases, if you are buying into a gated community, some homeowners association collect a few months in dues upfront, in addition to application fee and any other fees that may come up. Plus, this is a big one. The bank will want to see reserves, also known as extra money left over in your account after closing. It could be 2 or 3 months mortgage payment. Once you believe that you have met all these requirements and you are ready to take that leap, go and talk to your bank, your mortgage broker, or your credit union and get that pre-approval letter so you can start your home buying process.